Ever wonder why the Fed raising or lowering interest rates doesn't always match up with your mortgage rate? Let's break down how the Fed funds rate works, why it's different from mortgage rates, and how these changes ripple through the economy. Number one, the Fed funds rate or the overnight loan rate. Think of this as a rate banks charge each other to borrow money overnight. Why overnight? Because banks have to balance their books every day to meet legal requirements. If one bank is short on cash at the end of the day, they borrow from another bank just until tomorrow morning. The Federal Reserve influences this rate, and it's like setting the temperature for the economy. Lower rates equal easier borrowing and spending. Higher rates equal slower borrowing and spending. For example, you and your friends split dinner bills. One night you're short $10. You borrow it and pay it back the next morning. This is short-term borrowing, quick and cheap, and it's tied to the Fed funds rate. Compared to number 2, the 30-year fixed mortgage rate, driven by mortgage-backed securities. Now let's shift to a home loan. A 30-year mortgage is a much bigger deal than borrowing $10 for one night. It's a long-term commitment. These loans are tied to something bigger called mortgage-backed securities, or MBS for short. MBS are like giant pools of mortgages that investors buy and sell. Think of it as packaging a bunch of house loans together so investors can get a steady return from homeowners making the payments. What really influences the rate on your mortgage isn't the Fed funds rate, but how attractive those MBS investments are to buyers. When investors demand more on these, mortgage rates go down because it's cheaper to sell loans. When demand is low, rates go up to make the deal more attractive. For example, if you loan your cousin $100 to pay for a business project and she promises to pay you back in 30 years, before you lend her money, you check other investments. If other options are giving a higher return, like Treasury bonds, for example, you'll charge your cousin a higher rate. That's how the market for MBS works. The key difference is the Fed funds rate affects short term borrowing for banks and is not directly tied to mortgages. 30-year fixed rate mortgages are long term borrowing driven by investor behavior in the mortgage bonds market. The confusion comes in when the Fed lowers rates. People also assume that mortgage rates have gone down. But mortgages are influenced by more long term treasury bond yields and investor confidence in mortgage backed securities. Sometimes, even most times, mortgage rates go up after the Fed lowers rates because markets interpret the move as a sign that the economy is weaker than expected. Investors could get nervous about what's coming next, including slower growth. Long term investments like treasury bonds or mortgage backed securities are heavily influenced by investor sentiment. If investors worry the Fed's actions might lead to higher inflation later because more money is entering the economy, they demand higher returns to offset that risk. As investors sell off long term bonds, yields rise to attract new buyers. Since 30-year mortgage rates are tied to mortgage backed securities, those rates climb as well, even though the Fed just cut short term rates. So, why does this matter to you? If you're buying a home, please don't get too excited just because the Fed is lowering rates. Mortgage rates depend on broader economic trends, not just what the Fed does. You can reach out to me or another mortgage banker or keep an eye on long term yield bonds instead. Here's a real life example. In 2003, the Fed cut the Fed funds rate significantly to stimulate the economy after the 2001 tech bubble and 9/11. Short-term rates dropped close but to 1%, but by 2004, long-term treasury yields and mortgage rates began climbing. Why? Investors started worrying that inflation might spike due to the Fed's loose monetary policy, so they demanded higher yields on long-term bonds. Mortgage rates went up despite the Fed keeping short-term rates low. The Fed doesn't control long-term rates directly. They only influence them directly through economic signals. When the Fed cuts rates aggressively, it sometimes scares the market about future inflation or signals uncertainty, which pushes long-term rates higher. It's like trying to cheer up a nervous friend by saying, "Don't worry, it's not that bad." And they respond with, "Wait, What's so bad? Here are 10 items directly impacted by the Fed funds rate. Number one, credit card rates. Most credit cards have variable interest rates tied to the Fed funds rate, so payments go up or down when the rates change. Number two, personal loans. Unsecured loans for personal use often have rates tied to short term benchmarks influenced by the Fed. Number three, auto loans, short term auto loans. While longer term auto loans are less directly tied, short term auto loans can be directly influenced by Fed fund rate changes. Number four, home equity lines of credit. HELOCs typically have variable rates that rise and fall with the Fed funds rate. Number five, adjustable rate mortgages, not fixed rate mortgages, but adjustable rate mortgages have interest rates periodically reset, often tied to the Fed funds rate or similar indexes. Number six, small business loans, variable rate loans, offered to businesses with variable rates adjust based on changes to the Fed funds rate. Number seven, corporate lines of credit. Businesses with revolving credit lines often see rate changes tied to the Fed funds rate. Number eight, construction loans. Short term construction loans used to fund projects before permanent financing are influenced by Fed rate adjustments. Number nine, bridge loans. These short term loans used to cover financing gaps often have rates impacted by Fed policy. And number 10, payday loans. While already high in interest, payday loan rates can increase further if the Fed raises rates. 30-year fixed rates are not on this list. And the key takeaway to all this is Fed rate cuts don't always lead to lower mortgage rates because long-term rates are more about the market's perception of the future economy, especially when it comes to inflation and growth. Sometimes the very act of cutting rates signals enough trouble to drive mortgage rates up.